Ladies and gentlemen, traders and investors, hello and welcome back to our channel Polo Vega. Today we shall be doing our commentary on week 4/week 5 for the year 2025 and 2026. But before we go on to our commentary, let's first do the disclosure/disclaimer clause. Disclaimer/disclosure. The contents of this presentation are for information purposes only. The material has been obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the 27th of a series of interactive videos aimed at educating our viewers, and we would like to warn all our viewers of the risk associated with the business of trading and investment. Securities investment and trading is a highly risky business, and there exists a possibility of partial or total loss of investment. The ideas and opinions in our video are solely based on our analysis of the market, and we do not advise/recommend/guide anyone to take any trade based on the contents of this video, and we do not take any responsibility for partial or total losses arising out of trades based on the contents of this video. Ladies and gentlemen, traders and investors, as we all know, week 4 has been a tumultuous week and saw a lot of action in the metals and currency markets. The economic calendar was a quiet one except for the monetary policy and rate decisions for CAD and USD on Wednesday, the Aussie CPI on Wednesday, USD unemployment claims on Thursday, USD PPI on Friday, and CAD month-on-month GDP on Friday. It was a capitulation of the Dixie with various expectations of the Fed chair replacement and the unhinged rally of the males in the gold/silver club until Wednesday, and then the collapse of the males on Thursday and Friday that brought mayhem and carnage in the males market, which has shaken the faith of some who believed in replacing the faith in USD with hard metals. The complete story has been geopolitically driven and is far from economics based statistical analysis. The forthcoming week, which is week 5 of the new year, is laden with critical data release schedules. Of these, major releases are manufacturing PMI for the greenback on Monday, Aussie cash rate in early hours followed by USD JOLTS job openings on Tuesday, the Kiwi dollar employment data in the early hours, and the US ADP non-farm employment data together with the services PMI on Wednesday, the GBP official bank rate, and the Euro main refinancing rates announcement on Thursday, and finally the employment data for the loonie and the greenback on Friday. A very important week indeed, with lots of geopolitical tensions looming in the air, with Carney's speech at Davos followed by his telephonic conversation with President Trump, Prime Minister Starmer's China trip in week 4, the big trade deal signed between EU and India, and the mobilization of the American fleet to areas surrounding the Iranian borders. Therefore, we shall advise traders to stay glued to their computer screens and place their trades as carefully as possible, exercise all sorts of precaution, and please place tight stop losses to prevent depletion of hard-earned wealth by sudden surprise moves or market moves. After having gone through the economic calendar for weeks 4 and 5 and all the events of week 4, we shall now be touching upon two very important asset classes, which are indexes that play a very important role in the lives of traders and investors all around the world. We shall not be touching upon any of the metals this week, although gold and silver have had major rallies and major drops driven by emotions and news and not by technical or fundamental reasons. Dixie, or the dollar index, has been following the trajectory exactly in accordance with our projection week after week, although it has reversed a bit earlier from its controlling candle around 100 to make a new lower high 99, which could be the new controlling candle for its range-bound movement. After the rate cut decision due on Wednesday, the USD managed to gather some strength and reversed some of the expected area around 95.48. No matter what, we can see the dollar index respecting its lower pivots to the T and has not been able to breach the area between 95.2 and 95.5 ever since July 2025, in spite of 3 rate cut decisions in a row, combined with heavy geopolitical wind and weather that it has been experiencing during this period. The Dixie is still expected to continue trading range bound and respecting its high around 99 to 100 and its low around 95.2 to 95.5. Once it breaches either of the two limits, then one can see that the trading becomes a trend trading and not a sideways trading. We shall now talk about the performance and movement of the S&P 500 represented by ES charts this week. S&P 500 has been relatively a heavier index compared to the Nasdaq and is less volatile, although the two have followed a similar trajectory since April 2025. There was a sharp rise between April and August, then a bit of slowdown on a range bound movement until end August, followed by a sharp rise in September, and then a range bound movement for the last 3 months. The index has been range bound between 6800 and 7000. A break above 7000 and the establishment of a new low above 7000 could bring back the bulls to the market. A break below 6800 could open the opportunity for going through a long at 6670 with a stop loss at 6600, as a break below this area could establish a lower high, and one could see the bears rush in to take advantage of the break below the lower boundary of the range bound trade. As of now, it's still safe to take longs at 6800 and skim out small profits from the range bound trade. The show at 7000 could be dangerous as there are not many sellers in the area and the chances of blowing the roof are more likely than breaking below the floor at 6800 or 6600. The chart that we see here is the Dixie or the dollar index. We've already talked about the index in our commentary earlier, but we should now just go through the chart and see the trading areas where one can go in and come out. The trade has been range bound since July up until now. Earlier, the upper boundary or the upper limit used to be 100, but this time it managed to turn around at 99 purely because of a news driven event on that particular day. However, the bottom boundary, which is around 95.5, has been respected for the last 6 months and still is getting respected, where we could see there was a bounce last week at 95.48. The trades taken on Dixie should still be range bound and not in any direction. Therefore, one can either go short at 99 or go long at 95.5 with tight stop losses, as the boundaries have been hit quite sometimes and it could be that the orders are getting depleted at each end. Therefore, there are chances of the index breaking above or below these boundaries. However, the chances of breaking the lower boundary are higher than those of the higher boundary, purely because of the economic and the geopolitical situation in the United States of America. The chart that we see now is the ES or the S&P 500 chart. We've already spoken about the S&P 500 in our commentary earlier, but we shall still go through the chart and see the areas which could be interesting to a trader. As we can see that the S&P 500 is been in an uptrend with occasional or no very occasional slowdowns in between with range bound trades. The gradient of the rise or the uptrend has been flattening since October, November. However, the index has been printing higher lows after higher lows and been maintaining an uptrend. It's only in the last couple of weeks that the higher high at 7027.60 has not been broken and is been contained because of lack of stimulus. So a trader to take an uptrend has to wait for this particular line to be broken and the establishment of a higher low above this area. Otherwise, one has to wait for the price to dip into the 6800 area to take a fast skimming profit between 6800 to 7000, or if it breaks below 6800, 6672 could be another area where one could go long with a stop loss at 6600. But below 6600 it becomes dangerous to go for a long, and instead one should wait for a lower high to be formed and look at the possibilities of going short into a high seller's area or a decent supply area created by the traders on a future date. We hope that our weekly commentary has been informative and exciting enough for you to come back and watch them every week. We shall continue with our commentary and be touching upon events which are the highlights of the week economic calendar, and shall also talk about interesting asset classes each week. If you liked our video, please give us a thumbs up and press the button underneath to subscribe to our channel Polo Vega and watch all our videos. You may also visit us at our website www.polovega.com and get in touch with us through our Twitter handle at PoloVega. Please keep saving, keep investing, and keep trading safely and keep getting wealthier until we meet next. We thank you for watching our video. Please like, share, and subscribe to our channel Polo Vega.